The truth is, sometimes we get comfortable with the ordinary, sitting inside the lines others have drawn for us, when there is an entire blank canvas of a world waiting for us to trust fall into solutions to questions not even asked yet, to rise, revise, and recognize that remarkable is not only possible, but it is necessary. It is the result of daring to imagine beyond this partition of parameters, always onwards, upwards, and forwards, towards the whys of ideas redefined, the what-ifs of partnerships, the how can we improve this. This is more than a common belief that in order to succeed, we must always see details 3 steps ahead. This is not about spotting market trends or hopping on bandwagons, because many others have been there, and quite frankly, so have we. But we are also about people. Shorooq, the right fit in the right place, like perfectly timed happenings matching skills with partners already found, where the sum of parts can create platforms only teamwork lets you reach. No, not you, us, plural, collective, a home field advantage, expertise meeting the opportunity of what we did, are doing, and will do, investing in holding open doors wide enough for impact to walk through. So we continue being the outlier, the deviation, the above and beyond expectation, the ones uncomfortable with being ordinary. Today is the day. Join Shorooq Partners.
Welcome everyone to our second episode of your weekly MENAP Venture Debt Series, where every Tuesday at 3 p.m. GST, Shorooq Partners and IMM Investment Global go live on LinkedIn, Twitter, and YouTube, where we collectively talk venture debt and answer any of your questions. If you're watching this through our LinkedIn, Twitter, or YouTube accounts, remember to follow, subscribe, and click that bell icon to get notified with all our news, events, and updates. This show is brought to you by Shorooq Partners, the leading tech investor in the Middle East, North Africa, and Pakistan. And I'm your host, Tariq Fouad, Head of Growth at Shorooq Partners. And I want to thank you all for tuning in from wherever you are. Today, we are pleased to be joined by Sean Jin, Director at IMM Investment Global. Obviously, Nathan Kwon from Shorooq Partners. And finally, Samir Yamani, Partner at Shorooq Partners. Thank you so much all for joining us today.
Thank you, Tariq.
Great stuff. Great, Nathan. Thank you. I believe let's start off with you, Sean. If you can maybe introduce yourself and introduce IMM Investment Global for everybody joining us today.
Sure. Thank you for inviting me to speak on this occasion. My name is Sean. I'm a director of venture investment at IMM Global. IMM Global is the Hong Kong subsidiary of IMM Investment Corp, which is one of the biggest and largest venture capital firms in Korea. We've been around business for the last 23 years, since 1999. And we cover from early stage investments to mid stage, all the way to the late stage. So everything from venture capital through a private equity investment. So our AUM is around 5 billion. And IMM Investment Global was set up a couple of years ago to expand IMM's business to the global market. And we are very excited to start our partnership with Shorooq Partners to launch our region's first venture debt fund. And happy to join.
Super, appreciate it. Thank you so much, Sean, for the intro. Samir, if you would please introduce yourself to everybody joining us today, and if you can also give us a snippet of what Nahda Fund is all about.
Hi guys, thank you for joining from wherever you may be. My name is Samir Yamani. I'm at Shorooq Partners. leading the Nahda Fund. The Nahda Fund is a venture debt series, Nahda Fund I being the first such venture debt fund in the region, regulated and situated in the ADGM. Very much looking forward to speaking with our colleagues and co-GP partner IMM. We work very closely with Sean and the team, and really excited to have them on board for this particular series and for the next few ones over the next couple of weeks.
Thank you so much, Samir. Nathan, that leaves you. If you can maybe quickly introduce yourself and your role in the venture debt team.
Hi, guys. For those of you tuning in for the first time, my name is Nathan. I'm a senior investment professional at the firm. I lead the venture debt fund along with our colleagues here. Prior to joining Shorooq, I helped set up one of the very first venture debt funds in Southeast Asia, and I am incredibly excited to be bringing this new asset class to the MENA region as well. Happy to join you guys.
Super. Thank you so much. All you guys are doing marvelously great today. We obviously are trying to, every single week, we're trying to kind of just take in one question and kind of double click on, right? And today's or this week's question is all about, when is it right for a company to raise venture debt? And is it any different in terms of a process in kind of raising venture debt than it is for venture capital? And I would like maybe, Sean, for you to kind of take the first stab, is from your experience, what you've seen are maybe I would say the early signals that you would like to see in a company for it to be considered for venture debt.
Sure. Venture debt is an instrument that is recognized as a stable kind of asset class. In markets like US and India, they already exceed over 10 to 15% of the total venture investing. And this instrument is typically used to fuel companies' growth once the company has validated its business model. So it might not be applicable to apply this instrument to early stage companies like pre-Series A and even sometimes for some other companies in Series A, but rather those that have stronger business model, that have gotten rid of the initial risk, and those that have clear vision as to what it is what is necessary for the company to grow, so that instead of financing the entire capital requirement through dilutive measures, which is equity, you sort of use this to boost your growth. And because the nature of the instrument is that you have to collateralize for the loan base and the asset, so there has to be a tangible asset that we will be able to use.
Beautiful. Thank you so much, Sean, for bringing this up, because last week question, I believe, from one of the audience was, what kind of collateral does a startup need to provide in return of kind of getting venture debt? And that's a great segue for maybe Samir, if I add you here, if you can maybe add on top of what Sean has said, from a financial perspective, what further signals do you need to see in a company to actually get them debt?
Yeah, absolutely. So as I mentioned last week, typically about 47% of venture debt happens around Series A. Typically what we would need to see is a level of maturity in the company to be able to have their intellectual property fully registered, their organizational structure to be fully legally compliant, and for their internal reporting and financial due diligence and compliance to be in order. We appreciate a lot of these companies are still work in progress, but ultimately the companies need to be organized really for growth beyond Series A. And so there's an inflection point that typically happens around the Series A time, sometimes just a little bit before as well, where they're about to take off to become a much more well-organized and professionalized company. From a security perspective, obviously, there's a variety of different securities that we are able to take depending on the nature of the business that they have. If we look at fintech companies, typically these are very intangible assets like their intellectual property that they have locked in. We've also looked at transactions from receivables all the way to inventory, and we also take and look at other forms of security, for example, shareholder pledges, as well as operational pledges, all the way down to more specific forms of security like mortgage assignments and IP.
Thank you so much, Samir. That is certainly a level down in terms of the details there. And maybe to add you there, Nathan, have you seen from your experience? Have you seen from your experience a need for board seats? Is that something common that you see with venture debt? Is it a requirement?
That's a good question, Tarek. So typically, we do like to take board seats in the companies we invest in. It's not an absolute requirement for us, but it does help provide a presence from the credit holder's perspective at the company's board level. And from the investor side, this helps us to gain a greater insight into the company and to be actively advising or providing support in terms of management of the cash flow, the financials of the company. From the company's perspective, it is also beneficial to have someone at the board level so that they have full insight into the company's operations and that they can provide a level of comfort to the credit holders as well. So even though we are a investor we are a financial investor, of course, the investment is grounded by the company's operation and business. So if the company has a regular venue to provide that comfort to us, it is always a win-win for both of us. Finally, another perspective to have is the other equity holders on the board. So usually other members of the board come from investors at the equity level or part of the cap table. And by having the credit holders at the board, it provides a venue for the two different type of investors to collaborate and to augment each other, because there are certain different aspects that we see. And the equity investors especially like to see credit holders represented at the board because they know we are playing that fiduciary guardian. We're providing that additional level of insight for the company's governance, management of liquidity and finances.
Thank you, Nathan. I think that was an extremely a beautiful answer on that question that was actually asked by Sarah last week. So I want to thank our audience for asking questions. And this is a reminder for whoever is watching this, we have IMM Investment Global and Shorooq Partners on live today. You can ask any questions you might have for our panelists here, and we'll be able to kind of obviously share them and answer them right away. So maybe a last question, and obviously I want to thank everybody who's putting their questions there in the comments. I promise you that we're going to go through them. But maybe a question for you, Sean, there. We've touched on board seats, we've touched on collaterals. If you can kind of double down on, and you've kindly said, usually you wouldn't necessarily see startups, prior to Series A actually raising venture debt. It's not necessarily common. Yet, for example, today we all kind of celebrate the news of Retailo, raising their Series A round, which partly was debt, and Nahda Fund had joined that round. It would be interesting to kind of, from at least experience and maybe high level thoughts there, what did you see in Retailo that you would like to see in other startups that would like to raise venture debt?
Sure. Yeah, we are very much excited about Retailo because if you look at the business, it's only been around over the past couple of years, but the kind of growth and the infrastructure that they have been able to build over that course of time have been very, very impressive. I think it actually had an amazing product market fit. So the macro story was very strong, but the way they were able to address the pain points of customers and suppliers in the region, I think a lot of it actually comes from the capability of the management and their experience of building other startups. But if you look at their infrastructure and all the core business capabilities that they built, especially on technological kind of infrastructure, it's not a typical Series A company, and they have been able to show simultaneous growth in new cities, and they continue to expand into other cities, sort of leveraging the playbook, the success recipe that they were able to formulate. So, I mean, this is like a very good kind of target for us, because we can reference their playbook in the existing initial entry cities. And that way we were able to understand what kind of unit economics that they're operating based upon, and what kind of capital requirements that are necessary for building such infrastructure. And because they're very sound on the back end, we see that as a great source of operating leverage. Once you have this infrastructure in place, it provides a good stepping stone for other city expansion. So that's like the type of the DNA and the infrastructure that we're looking for out of our targets.
Thank you so much, Sean. I think you've kind of hit multiple punchlines there on the head, and I think unit economics are underestimated. I think in a world where we all celebrate who fundraises what, sometimes the unit economics don't end up being given the light it should. And I think obviously with Nathan and Samir working very closely with Retailer, I would love to grab their insights with what they've seen in the company and what would they like to also see other than that in the company. And maybe start with you, Samir.
The real standout things on Retailer over and above the underlying fundamentals of the company itself. I felt the management team had a real maturity about them. They were very clear about what they're good at and what they are working on to improve. For us, their understanding of the liability that they would be taking on and how they would service that. And of course, we work very closely with them to build an instrument that works with them and helps them fuel their growth going forward. We found their reporting to be very clean, on time. A lot of the gaps which were identified, they had already highlighted, and we're working very fast to address those. That type of impression that a company gives is really important over and above the underlying fundamentals, because it really shows a level of maturity that going forward, they understand the impact that having a liability on their balance sheet will have, not just in terms of their obligations to the borrower, but also how to manage that going forward, both internally and with potential new lenders that may come going forward. Because ultimately our interests are that the company does really, really well. And the better that they take care of these basic fundamentals, the more likely they're able to take more additional debt, grow further, and fuel their growth to new territories and countries as well. That for me, under the leadership of Talha, the co-founders Wahaj and Himag, was something I would really highlight as something I was very impressed with, and they're going to do really well going forward.
Amazing. Thank you so much, Samir. And congratulations, obviously, to Retailo, Talha, and the team. We are super proud as Shorooq Partners to have obviously supported them and invested in them at pre-seed, seed, pre-series A, series A, and through debt financing through Nahda Fund. So we're extremely, extremely proud of the team. I just want to remind everybody who's watching us, throw your questions, any questions whatsoever. If it was for IMM Investment Global, or if it was for Shorooq Partners, or if it was in general, anything related to venture equity or venture debt. And I think this kind of comes to today's Q&A session. And I would love to maybe start off with Nathan there. And Nathan, I'll put you on the spot there. But we have a beautiful question from Sanam. Thank you so much, Sanam, for asking that question. Can you dive into realized and unrealized IRR and debt repayment? That would be appreciated. If you can explore a little bit more about that debt repayment methods and its calculations, that would be great, Nathan.
Great question, Sanam. So, judging by the content you're asking, I'm assuming this is from the question is from the perspective of an investor into the fund, since you're asking about the fund's return. If not, do type into the comment and let me know. Otherwise, let me answer this from the point of an investor into the fund. So the way we calculate the returns of the fund, there are two aspects. So for every venture debt, there's a debt portion through which we receive regular cash interest. And then there's also a portion of equity that we get through warrant options into the companies we invest in. So these two parts of the investment are kept separate when we evaluate our fund's holdings. On the debt side, it's relatively easy to calculate the future value or the fair market value of these investments because there's a regularly projected cash flow. And in that sense, it is one of the advantages, I'd say, that a debt fund holds over an equity fund, that there's a relatively stable cash flow, which is projectable, and it translates into a concrete return for the investors. Also, in terms of timing, for VC, it does take a bit of a time for the returns to be materialized. We need the company to grow and exit in due course. Whereas for debt, even when there is no particular exit event, there is a steady stream of cash flow that is coming in that helps us generate returns to our LPs and investors under a much faster timeline. Now, on the warrant side, that is the options for the equities in the companies we invest in. This is basically evaluated in the same way you would for a typical VC fund. So the portion of the warrants we get is smaller, of course, than for a pure venture equity fund would. But we always make sure to have a portion that is included within the debt so that the interest of the investors, the fund, is aligned with our companies. And I think that is something that also from the founders and the entrepreneurs' perspective, it is a good angle to have in mind. The reason we take these such warrants is so that we're not a pure credit holder, but we're invested in the company's growth, and we have a stake there so that we can fully support the startup in their journey. But anyways, in terms of valuation, since that is an equity stake, it is evaluated the same way a VC fund would be. We mark the investment at cost until there is an exit event or that there is a new round with a confirmed increased share price per share, which is then reflected onto our valuation of the investment holding.
Yeah. Thank you so much, Nathan. Definitely. And Sanam, thank you so much for this question. Please feel free to kind of write down any comments there. And if you wanted us to kind of answer that any differently. But I would love to kind of grab Sean's input on this as well. From your experience, Sean, and maybe just to kind of complete or add on top of Nathan, have you seen this played any differently? And IMM Investment Global, for it to kind of co-run or co-manage Nahda Fund in the region, which is quite new to this debt facility. What kind of got you excited about this as investors, right? And what are you looking into kind of achieving over the course of a few years? So yeah, go ahead.
So I think the beauty of venture debt is that there's a strong demand for entrepreneurs that already have a clear vision as to how they want to grow and pass the test of testing different scalability of their existing business. If in order for them to grow quickly, debt is obviously a cheaper capital to use instead of financing the entire the growth round through equity instrument. So I think we definitely have an advantage there. For businesses that we know that will be able to grow like the one that we saw in the retailer, I think this is like a great kind of story for us to get involved in and make sure that the company sort of maximize their growth potential over the life of 2 or 3 years, and based on the powerful growth story, they'll be able to enter into much more interesting discussions with hopefully international investors like IMM. So I think it's important to diversify the shareholder base, the cap table, and invite investors that have experience with success stories elsewhere in the world, especially when your company its core business capability is based upon technology. The beauty is that you're able to grow globally, and given the fact that MENA is a region where you see a lot of startups, not just limited to one specific geography, but they're more interested in expanding into other regions simultaneously. I think these types of scalable growth practice is something that global investors want to see. So we would like to play the role in coming to the region, going through various exercises and make sure that we come up with an attractive growth story so that we can show to other attractive global investors to have more exposure in the region as well.
Love that. Hopefully, and all investors that are out there that are interested in joining a venture debt fund, just remember you can always reach out to us at Shorooq.com, or you can also visit imm.co.kr today. Thank you so much, everyone, for kind of posting these questions. We have a few more to go through, and I would like to probably add as well, Samir. And Samir, I would love your opinion here when it comes to Muhammad Salim's question. Muhammad, thank you so much for asking this question. What is the common ratio of interest that companies shall accept? Does the valuation of a startup have any impact on the success of the investment?
So I'll just reply to that backwards. On the valuation point, what we're looking at seeing is that there is valuation growth in that company rather than an absolute number per se. Typically, the companies we're looking at are valued over $80 to $100 million generally, but we also look at companies below that. The other point in respect to valuation is we're interested in seeing who these companies are, or individuals that are investing into the company, to get a sense of the conviction the investors have in the company and the sophistication that the investor group has, and the company by extension, after which we then look at adding a new type of asset class to that particular company. In respect to the common ratio of interest, presumably this question is about how leveraged the company is. Typically, we are looking at companies, and most of the companies that come through to us have no debt exposure. We have looked at some syndicated facilities where a company already has some level of third-party liability on them. We are also structuring our transactions in a Islamic compliant manner. So in both respects, we're ensuring that the company is not over leveraged, and that can mean different things depending on different companies. So there's no specific answer from a exact common ratio perspective for Muhammad, but happy for you to, of course, reach out to me and that we can provide a more specific answer for you depending on the particular company you're referring to, Muhammad.
Love that. Love that. Thank you so much, Samir. And you actually touched on a topic that we will discuss next week, which is how do we structure a venture debt round, right? So for everybody who's watching us, stay tuned for next week as we speak and kind of double down on how do we structure a venture debt round. And thank you so much, Mohammed, for asking this question. Thank you, Samir, for a beautiful answer there. Last question. And I would love to pull in Nathan there. Nathan, we have a question here. What is the difference between venture debt that we offer and the classic debt in terms of collaterals, debt rate and repayment conditions?
So in general, you could think of venture debt as a more relaxed version of a traditional debt. And that is especially the case for the kind of loans that you'll be able to take out from banks in the region. So if you have ever had experience going to the banks here to take out a loan, you'll see that they want to collateralize and guarantee the loan 3 times over. They will ask for a myriad of documents and specific physical collaterals, as well as personal guarantees, and which could hold you to be personally liable. On top of that, there will be a number of covenants. If you're taking out the loan as a company, there will be a number of covenants that you have to have that will very severely limit the way in which a company could be operated. The key difference between here and venture debt is that although we definitely do take securities in order to underwrite the loans that we give out, we make sure that we work with the company's founders to limit the amount of hindrance that could provide on the day-to-day operations of the business. Also, compared to a traditional debt, we don't try to collateralize the loan multiple times over. As long as the basis is there to cover the underlying amount, then we're happy with that. And which also kind of this sort of attitude is also reflected in the covenants we take. So there are 2 types of covenants to get a little bit more specifically into this. There are positive covenants, which dictate a company has to do certain things. And there are negative covenants, which means as long as you don't do this or you don't breach this standard, you're free to do whatever you want. So as venture investors, we do try to utilize negative covenants and we try to keep the operations of the company at the hands of the founders. In the end, and I think this is a key point here, in the end, we only invest in companies that we believe in and the founders that we trust in. And that means we trust them to be the best at running their business and growing the business. We're not here to take over the running or the operations. We're here to provide the capital to support the growth of the company they're in. So we try to make sure that flexibility is there for the founders to fully operate under. And this also goes into the previous component that I was talking about, which is the warrant side, which helps us align the interests between the credit holders and the company. But more on this in next week's session when we actually get into the specific structure and the mechanics of it.
I love it. I love it. You were faster than me, Nathan. That's great. I appreciate it. Thank you so much, everyone, for asking these beautiful questions. It's so much to cover under 25 or 30 minutes. So unfortunately, we've come to today's end of live session. I would like to personally thank Sean Jin, who's the director at IMM Investment Global, and you guys can check out imm.co.kr today. Obviously, want to thank my colleagues Samir Yamani, who's the partner at Shorooq Partners, and Nathan Kwon, senior investment professional in the team, for joining us this week and for giving everyone some of these beautiful brain juices that they've got going right there. Remember, guys, visit Shorooq.com if you're a startup looking at funding or you're a startup looking at just getting advice and picking our brains. You can always reach out to us at Shorooq.com. Click that Get Funded button and you'll be able to reach out directly to the investment team. Otherwise, follow us at Shorooq Partners, We post a lot of amazing things, and YouTube channel has all the previous sessions recorded, so you have never missed a thing, right? Go in, enjoy some of these videos and talks where we discuss everything. From myself and from Shorooq Partners, I wish you all a very pleasant day.